Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing language of corporate filings, and today we've got a real doozy from Candel Therapeutics Incorporated. This isn't just any financial report, folks. This is a deep dive into a company trying to navigate the treacherous waters of drug development, and let me tell you, the story they're telling is all about ambition, risk, and the relentless pursuit of funding. Before we dive in, if you appreciate getting straight insights from these dense corporate documents, make sure you are subscribed and maybe even hit that notification bell. And hey, if you want to join a community of folks just like you dissecting these filings and sharing insights, check out the Discord link in the description below. Alright, let's get right into the heart of Candel Therapeutics, Incorporated's latest earnings report for the quarter ending September 2025. Now, what we're looking at here is a company that is still very much in the development phase, meaning they are spending a lot of money to create new medicines. And the big question is always, are they making any money back? And more importantly, can they keep the lights on? First up, let's glance at their balance sheet as it stood on the 30th of September 2025. Cash and cash equivalents were sitting at a healthy $86.9 million. That sounds like a lot, right? But remember, drug development is insanely expensive. They also have about $3.1 million in prepaid expenses and other current assets. Total assets come in at just shy of $93.6 million. On the flip side, their liabilities are much lower, around $13.4 million. This seems good, but we need to look closely at where their money is going and coming from. Looking at their current liabilities, accounts payable were a little over $1.1 million, and accrued expenses were a bit over $5.1 million. This is pretty standard stuff for a company of this size. Now here is something that catches the eye, the warrant liability. On the 31st of December 2024, it was a hefty $21.7 million, but by the 30th of September 2025, it had completely vanished, $0. This is a big deal because warrant liabilities often represent financial instruments the company has issued that give someone the right to buy their stock later. When this disappears, it usually means those warrants were either exercised, meaning people bought stock, which is good for the company's cash, or they expired, which means that potential future dilution didn't happen. In this case, the financial statements show that over 3.3 million shares were issued upon exercise of pre-funded warrants during the 9 months ending September 2025. So they got cash for those, which is a positive sign. Looking at the details of their warrants, especially the conditional Series B warrants, they are designed to vest only upon the achievement of certain financial milestones or share price targets. This is a way for the company to issue potentially dilutive stock, but only if they hit certain targets, creating a win-win scenario if they succeed. The fact that these are conditional is important for managing investor expectations and potential future stock dilution. Now let's talk about stock. As of September 2025, they had over 55 million shares of common stock issued, and about 54.8 million of those were actually outstanding. This number has grown quite a bit, indicating they've been issuing new stock, likely to raise money for their operations. That is important to remember as a shareholder, because it means your ownership stake might be getting diluted over time. Now, for the moment, many of you have been waiting for the income statement. For the 3 months ending September 2025, they reported a net loss of $11.2 million. That is a good chunk of change, but it is actually less than the $10.6 million loss they reported for the same period in the previous year, 2024. So they are losing money, but perhaps at a slightly slower pace in the short term. Digging into the expenses for that quarter, research and development cost them $8.4 million. This is the engine of a biotech company, and it is pumping hard general. And administrative expenses were $4.7 million. Combined, that is over $13 million spent just to keep the operation running and developing these drugs. Now let's zoom out to the 9 months ended the 30th of September 2025. Their net loss here was $8.6 million. That sounds way better than the $41.1 million loss in the same period of 2024. What a difference. Looking at the 9-month numbers, research and development expenses were $19.4 million, a significant jump from $14.4 million in the prior year. That increase really signals where their focus is, pushing these drug candidates forward. General and administrative expenses also rose from $10.7 million. This is where things get interesting and a bit complex. Remember that warrant liability that disappeared. For the 9 months ending September 2025, the change in fair value of warrant liability shows a positive $21.7 million. This means the value of those outstanding warrants went down significantly, which is good for the company's reported earnings. In contrast, for the same period in 2024, there was a negative $14.9 million, meaning the value of those warrants increased, costing the company on paper. This swing is a major reason why the net loss looks so much better in 2025 compared to 2024. It is not necessarily that they are making more money from operations, but that the financial instruments they've issued are becoming less of a liability on their books. Let's talk about money in the bank and money that needs to be paid back. As of September 2025, they had about $87 million in cash. But here is a key event in October 2025. Shortly after this report period, they entered into a new loan and security agreement with Trinity Capital Incorporated. This deal could give them up to $130 million. With the first $50 million already drawn to pay off their old loan with Silicon Valley Bank, or SVB, this significantly reshapes their debt situation, moving from a smaller loan to a much larger one, secured by all their assets. Imagine this, they paid off their old debt and took on a much bigger one, with the new lender providing a lot more capital, but also taking a much closer look at their assets. And as part of that new loan, they had to issue a warrant to purchase up to 254,642 shares of their common stock. This is a common practice with these types of loans, where the lender gets a little slice of potential future upside through stock options. It is a way for lenders to get compensated beyond just the interest payments. Now, what is all this money for? Candel Therapeutics is all about fighting cancer with these novel viral immunotherapies. Their lead drug candidate, California N-2409, has been through a big phase 3 trial for prostate cancer, and the news is good. They announced positive top-line data, meaning the trial met its primary goal of significantly improving disease-free survival compared to placebo. This is huge because it is not just a good trend, it is statistically significant. The FDA even granted it Regenerative Medicine Advanced Therapy or RMAT designation, which is a big deal for development and potentially for faster approval. They are now talking with the FDA about submitting a marketing application in late 2026. They are also seeing encouraging survival data for CAN-2409 in non-small cell lung cancer, or NSCLC, for patients who have not responded to other treatments. The median overall survival was over 24 months, which is a significant improvement over the typical survival rates for this tough patient group. This has them planning a new phase 3 trial for this indication. However, not all paths are paved with gold. For pancreatic cancer, they decided to pause further clinical development of CAN-2409 unless they get external funding. This is a tough but smart business decision when resources are limited and you have to prioritize. It signals a focus on the more promising avenues. Then there is CAN-3110, their other key drug candidate being tested in a tough area, recurrent high-grade glioma, or HG, a very aggressive brain cancer. They've received Fast Track designation and Orphan Drug designation for this, which indicates the FDA sees its potential for a serious unmet need. Early results show promise for improved survival, especially with repeated dosing. In fact, a study published in Nature highlighted significant immune activation and better survival in patients treated with CAN-3110. Now, like many companies, Candel Therapeutics has had its share of related party dealings. In March 2014, they entered into an exclusive licensing agreement with Ventagen Incorporated. This sounds normal, but here is the catch: stockholders of Candel Therapeutics, including founders, own a significant chunk of Ventagen. While the company states these transactions were on an arm's length basis, it is something to always keep an eye on when a company does business with entities connected to its own leadership. Let's talk about the risks. And believe me, there are many. It is a company with a limited operating history that has not generated revenue from product sales. They expect significant expenses and losses for years to come. The biggest risk underlined repeatedly is their need for substantial additional funding. If they can't get it, they might have to delay, reduce, or even stop some of their product development. This is the classic biotech gamble. They are very direct about this. They need a lot more money. They believe their current cash and the new loan will last them into the first quarter of 2027. But that is based on assumptions, and the drug development world is full of surprises. They'll need to keep raising money through stock sales, debt, or partnerships. Any new stock sales mean you own less of the company, and debt means they have to make those payments no matter what. This is an understatement. Biotech stock prices are often a roller coaster. A failed trial, a delayed approval, a competitor's success, any of these can send the stock price plummeting. They are warning investors that this volatility is normal for them right now. This is the gatekeeper. Getting a drug approved is a marathon, not a sprint, and it's run with no guarantee of finishing. Any hiccup here can set them back years and cost millions. They're hoping their prostate cancer drug gets approved, but that's still in the future. The drug development world is crowded, big pharma, other biotechs, all fighting for the same patients and the same funding. Candel Therapeutics is up against some serious players, and they need their drugs to be not just good, but significantly better, safer, or cheaper to win. They don't own everything they're developing outright. They license a lot of their technology. This means if they mess up the terms of those licenses, or if those agreements are disrupted, they could lose the rights to their own potential blockbuster drugs. That is a critical dependency. This is a direct warning to investors. Expect wild swings. They are telling you up front that the stock price can go up and down dramatically, and you could lose money. It is a high-risk, high-reward environment. This is a bit of legal boilerplate, but it is important. They are essentially telling stockholders that if you want to sue the company or its directors, you'll likely have to do it in Delaware or Massachusetts. This can make it harder and more expensive for small investors to pursue legal action, essentially shielding the company somewhat. This means they get a break on some of the reporting rules. They don't have to reveal as much, and their auditor doesn't have to do as much checking. This can make the stock less attractive to some investors because there is less transparency, but it also saves the company money. They're being upfront about it. Protecting their intellectual property, their patents, is like defending their castle. Lawsuits are expensive and they don't always win. If they lose patents, competitors can come in and make similar products, which is a death knell for a young biotech. So what is the verdict on Candel Therapeutics Incorporated? Well, they've got some genuinely exciting science, particularly with CAN-negative 2409 showing real promise in prostate cancer. That FDA designation and positive phase 3 data are significant wins. CAN-negative 3110 also shows potential in a very difficult area of brain cancer. However, the risks are enormous. They are burning through cash at a rapid pace, and their future is heavily reliant on securing massive amounts of additional funding. The new loan is a lifeline, but it also comes with significant obligations and potential dilution from lender warrants. The warrant liability disappearing is a good sign in the short term, but it reflects the complex financial instruments they've had to use to stay afloat. Their strategy seems to be focused on those areas showing the most clear promise, like prostate cancer and certain lung cancer indications, while wisely pausing or prioritizing areas like pancreatic cancer, where the path forward was less clear or more challenging. The reliance on licensed technology is a major point of concern. They're exposed if those license agreements go south. The market is volatile and the regulatory path is always uncertain. They are making smart moves by pursuing Fast Track and RMAT designations, which could accelerate development, but there is no guarantee. Their biggest challenge, as they themselves admit, is funding. They need to keep raising capital, and that will continue to dilute existing shareholders and increase their debt burden. In conclusion, Candel Therapeutics is a high-risk, potentially high-reward biotech. They have promising science and some encouraging clinical trial results, but they are a long way from profitability, and their financial runway is always a critical factor. The next few years will be absolutely crucial in seeing if they can navigate these hurdles and bring these potentially life-saving therapies to market. Alright, that is our breakdown of Candel Therapeutics Incorporated's latest filing. What is your take on these numbers, the risks, and their development strategy? Do you see them as a promising investment or a high-risk gamble? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. And remember, for more active discussions and direct access to our community, don't forget to check out the Discord link in the description. Thanks for watching, and we'll see you in the next Decode.